Hello, my name is Garth Wheeler. I am with Bob's Business Accounting. Bob's Business Accounting is accounting for the small business owner. Bob's Business Accounting is a full-service accounting firm. The chief officer, which is me, Garth Wheeler, I have over 30 years experience and have my certified public accountant license. I started Bob's Business Accounting because I saw a need and felt a need for small businesses to obtain some help with their accounting. Many small businesses need a good priced accounting firm, bookkeeper, that will be able to help them with their bookkeeping and accounting needs. Bob's Business Accounting provides accounting coverage throughout the Utah and Intermountain area. Garth, myself, is QuickBooks certified and is listed on the QuickBooks Pro Advisor list in the Syracuse, Utah area. Bob's Business Accounting services all bookkeeping, accounting, income tax preparation, new business setup. If you are a new business and you need to be set up with the federal or state tax ID numbers, I can help you with that. Or if you need advice on what type of organization you should set up, I can help you with that. I can do accounting system troubleshooting, financial planning, and offer investment advice through an affiliated associate. When you start a small business, oftentimes you have a lot on your mind, and accounting is generally one of the least things that you feel that you have time to worry about until it becomes time to have your taxes done. And then all of a sudden you realize that you needed to have something put together so that you can have taxes done. An accountant can prepare tax returns, but they can do so much more. For example, they can review your financial statements and analyze the success and failures of the year. I have a client who started their business in October of 2014, and they hired me to do their accounting for them, and I have prepared their financial statements and have indicated to them a graph that shows the revenue growth for the 6 months that they've been in business, and it's quite impressive, and also the expenses and what their profit was. Recently, they hired a new truck driver, and as a result of this, they were able to increase their revenue, but the expenses also increased at a higher rate than what their incremental revenue growth was. I was able to point out to them this, what the result was of them hiring this driver and the impact on their financials. The comment made was, well, we are still making profit, and that's good. And that's true, they were making a profit. So they were able to know what it was costing them for that incremental revenue growth. A bookkeeper or an accountant, good accountant, can also help you with the preparation of your budgets, banking relations, suggestions on what could be changed to ensure greater success. Discussing banking relations, it's very important to have the credibility of a good accountant behind you when you go to the bank, and be able to discuss the numbers with confidence and be able to point out to the bank what has succeeded and not, and to help them to understand, help the bank to understand that this person is a going concern, that he's going to be in business and be able to pay the debts that he incurs. A small business owner really should perform all accounting on an ongoing basis instead of just at tax time. You notice that picture of the receipts. That is just horrendous for an accountant to be given at tax time. They simply will not take the time to deal with it. Or if they do, they'll charge you a horrendous amount, $100, $200 an hour to deal with those receipts. So if you're able to, on an ongoing basis, perhaps weekly, keep on top of the input of your financial information, then at tax time it's simply a matter of printing out the reports and giving them to your tax accountant. Isn't that a lot more comforting, and knowing that you are not having to worry about spending hours and hours preparing this financial statement. You just have to push a button, and it's so much more effective that way. The input of financial statement data on at least a weekly basis is critical for the success of a business. You should also keep score of the business results, just like sports teams keep score. You should know the statistics of the business and how the income statement, the various accounts, and the cash flow are performing. It's very important for sports teams to keep the score, to know the statistics of what is happening, not only the final score, but what are the background behind the final score, the bases, the hits run, the hits made on a baseball team, or stolen bases, or other statistics such as that. And just as important for a sports team, it's also important for a business to keep score. Let's talk a little bit about the financial statements. The income statement reports on the growth of the company over a period of time. It'll detail the sales and expenses and show whether or not the company made a profit. Often the profit is called the bottom line, and accountants tend to turn into that mode where they're saying what the bottom line is. The balance sheet is a reporting of the financial strength of the company at a certain period of time. For example, if your year-end was December 31st and you ran a balance sheet, it would show your assets and your liabilities and your owner's equity at that period of time. The difference between the assets and the liability is what the owner has in the balance or owner's equity. When you're discussing the balance sheet, you need to realize that accountants think of something termed the matching principle. For example, they want to match income with expenses so that there's a steady flow. As a result of that, they will also do what's called depreciating the assets. For example, the assets are consumed through the process of creating revenue. And so as the assets are consumed, then the accountant will depreciate the value of those assets. Another thing to realize is that accountants will put on the balance sheet the cost of an item that was purchased or the asset. The generally accepted accounting principles means that the assets are put on the books at cost and not appreciated, even though they may appreciate in value. For example, you might have some land that you own, and certainly it could appreciate in value and might be worth 2, 3, 4 times the value of what you have it on the books. But accountants will only maintain that value of what you paid for it. The exception to that might be inventory or investments that you have. In that case, there's what's called the lower of cost or market. And what happens is that evaluation is made of the inventory or these investments and determined if the value of those has decreased. And if that's the case, then the value would be written down on the books. So hopefully I haven't talked too complex, but I just wanted to explain a little bit about the balance sheet and how things are recorded. When preparing ratios and comparing them to the industry and the prior year, it's important to realize that these ratios are key performance indicators. They, just like on an airplane, the gauges, or on a car, the odometer and the tachometer, etc., are indicators of things that you need to know while driving. The ratios are indicators of the growth of your business and how you are doing. And it's important to compare them to, as I stated, to your peers in the industry, or how you were doing last year or the year before on these ratios. I wanted to discuss some of the key ratios that a small business owner should know. The current ratio is the ratio that looks at your current life assets, those assets which will be consumed in a year, to the current liabilities, those liabilities that come due in a year. And basically it analyzes the ability to pay your short-term obligations. The return on assets is a ratio that analyzes the profitability that you're generating in relation to the assets. I mentioned that assets are consumed in generating revenue, and this return on asset ratio will analyze how efficient those assets are doing. The asset turnover is another one similar to the return on the assets, but it relates to the revenue that is generated per dollar of asset. The accounts receivable turnover, or days outstanding, is a ratio that tells how many days it takes to collect your accounts receivable, or A/R. This is a very important ratio for you to understand. If a customer is taking 45 to 60 days to pay their bill, then that's money that's being tied up and not available for you to use in growing your business. On the other side of that, the accounts payable turnover is how quickly the accounts payable is being paid. For example, most accounts payable are due within 30 days, 10 to 30 days. The question is, how quickly are these invoices being paid? Are you able to hold on to your money for 45 to 60 days? Or is your philosophy that you will pay all bills on time? The accounts payable turnover details this ratio and what is happening with how quickly invoices are being paid. The inventory turnover is how many days you're holding the inventory. If you have an inventory turnover of 2, or if you have an inventory turnover of 6, the 6 is a lot better. That means that you are turning the inventory over 3 times as much over those that have an inventory turnover of 2. That means that inventory is generating more cash for you, and you're able to use that cash to grow your business. The debt ratio is the proportion of assets that are financed by debt, or how much you are leveraged. And the profit margin is the percent of profit to revenue, meaning how much are you able to generate on the bottom line or in your profit compared to the revenue, the sales that you had. I also wanted to mention that accounting is an art and not a science. Many people who take Accounting 101 in college are taught and made to feel that it's just black and white. But there are so many gray areas and things that you can do as an accountant to help the company to show a profit through some manipulation. It's all legal, it's all according to generally accepted accounting principles, but for example, oil is a good example. If you have an oil company, how do they recognize the revenue that their sales that they get from oil? When are they required to recognize the expenses? Do they recognize only the oil that comes out of the ground and is actually sold, or the expenses relation to that? These are all items that you need to be aware of. Your business may have some areas that you need to understand. Inventory and recognition of inventory is another area that you could be manipulated. So it's important to review the notes of the financial statements and understand how the financial data is being reported. As I stated earlier, you need to know your cash flow statement. You need to analyze it and determine where your cash came from and where it went. The cash flow tends to be a forgotten report, but it's very important. For example, you need to understand that you're generating cash from operations. If you are having to borrow money to meet your obligations, then you will not be in business for very much longer. So be able to analyze your cash flow statement to see that you're generating cash from operations, and determine if you're having to borrow money or being able to invest money are very important things to review when it comes to your cash flow statement. After all, cash is king, and even though you may be profitable on your income statement, if you're not generating cash, you won't be able to stay in business very much longer. So, Bob's Business Accounting, you can reach me at, our website is bobsbusinessaccounting.com. Our phone number is 801-682-1887. To obtain more information on these accounting issues, if you have questions over what I've stated, or to obtain a free book detailing how to overcome the 10 major hurdles that are faced by a small business, fill out the form that you'll find on this site. And I'm glad that you were able to take the time, and hopefully I've answered a few questions that you might have as a small business owner about accounting. I'd be happy to answer any other questions that you may have. Thank you.